Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. We've got green on the screen again for a third night in a row. So let's look at the S&P 500, which was up 2% at 5,485. The tech-heavy NASDAQ was the outperformer, adding 2.7%. And we've got the Dow Jones Industrial Average higher by 1.2%, breaking above the 40,000 mark for the first time since mid-April, and that's now at 40,093 points. And most of the Mac 7 are higher. NVIDIA, Meta, Amazon, Tesla, and Microsoft among those closing in the green, and you've got them propelling the major averages to their third day of gains in a row. So let's check in now with David Dietze. He is the Chief Investment Strategist for Dietze Wealth Management Group. David, thanks for joining us on the show. How are you doing today?
Very good. Looking forward to talking with you here.
Great that you are doing so well. And of course, markets are doing well as well. So let's check in now with what's going on, because there seems to be a bit of momentum building up right now.
Yeah, absolutely. The S&P 500 just exited its correction. It's now up 10% since April 8th, which was the low point of the year when briefly, actually, the S&P 500 intraday was in bear market territory. So the buy the dip crowd have proven correct, although to be successful, you would have had to anticipate a lot of flip-flopping on the part of President Trump, both on whether Jerome Powell should be let go and also on the status of his tariff negotiations.
Yeah, there's a lot of back and forth going on. So what should investors be doing with the uncertainty? Should they be right now be more cautious and sell into a rally, or should they be buying on the dips?
Well, certainly with the market up 10% just since April 8th, we've had a third day in a row of the NASDAQ up more than 2%. Ryan, we haven't seen that for 24 years. You've got to believe that now we've gotten a little bit overbought here. And we certainly are seeing signs that China is not quite in complete agreement with President Trump, that in fact there's going to be a rapid relaxation mutually of the tariffs each other has imposed on it, with the latest argument being Trump saying they are in current talks, and China is saying, no way, that's fake news. So, if all of a sudden China gets stronger on saying, there's no talks and we're not even prepared to have talks, you could see this market pull back. So I think investors need to have a longer-term outlook here if they're going to step in tomorrow morning, for example.
Yeah, for investors as well, they would probably have options overseas to look at, with the valuations in the U.S. looking quite elevated. This could also be a factor for them to consider, where you have capital outflows going out.
Yeah, absolutely. And certainly we entered the year with the composition of the global stock market being at the highest amount in U.S. stocks versus non-U.S. stocks that we've ever seen in history, plus valuations, of course, being at a sharp premium to the rest of the world. And now we're seeing, of course, that the so-called U.S. exceptionalism isn't really that exceptional. And so I think investors are rapidly rebalancing those portfolios to reduce exposure to the U.S. And the performance has been awarded. Right now, the S&P 500, even though it's up 10%, is still about 10%, down 10% year to date. But the fact of the matter is U.S. dollar indexes are down almost 10%. So if you're sitting in, let's say, Germany, you've seen a 20% loss in your S&P 500, and guess what? People don't like that, and I think there's going to be a continuing rebalancing out of U.S. assets overseas, and that's going to be a headwind for U.S. assets.
All right, let's take a look at what you should be looking at more closely in the markets for potential picks. And you've got Intel in focus. They've just reported their earnings after the bell. It looks like they beat estimates, but gave a bit of a disappointing outlook. What's the story here for Intel for you?
we like Intel because, first of all, it's down more than half in the last 18 months, right? And so the stock is, much more attractively valued. The stock has only lost single-digit percentage versus its brethren. Its other semiconductor peers are down anywhere from 20% to, in the case of Marvell, close to 50%. So it's really outperformed its group. So we have a brand new CEO there, Tan, who has a couple jobs. One is he got to turn it around, but CEOs always like to reset the bar low in terms of expectations. So I think that's part of his strategy. He blamed a muted outlook because of tariff uncertainty. Of course, everyone has tariff uncertainty. No one knows what's going to go on, and he used that as an excuse. Plus, of course, part of his job is cost cutting. Now, how does he tell, 10, 20% of the employees to exit the door if at the same time he's telling Wall Street everything looks hunky-dory, right? Mm-hmm. So he had to, in my opinion, paint a very muted picture in order to get support for cutting costs. But what I do like, of course, is they still have that 70% market share in terms of PC computers. They have a lot of production with Taiwan, in Taiwan, which, of course, is not subject to China tariffs because it's not being made in the United States. And, of course, they do have this so-called 18A chip manufacturing process that they're developing, which could give Intel a nice technological edge on rival Taiwan. So for those reasons, we think this is a good time to buy Intel on pullbacks.
All right, talking about tariff uncertainty, the drug-making space has been bracing for tariffs and the impact they might have. But you've got your eye on Pfizer. Why is that?
So, Pfizer's part of the beaten down healthcare group. I think there's a couple things that stand out. One is, of course, the new head of the FDA is RFK Jr. We know he's anti-vax. We know that he's made a lot of structural changes in the FDA, which by all accounts will slow drug approvals. So pharmaceuticals very much out of favor. And, of course, now Mr. Trump is talking about leveling drug prices so they're the same as Europe and also placing tariffs on the importation of generic drugs. But I believe all this is discounted now. You got Pfizer, was in the mid-60s, is now in the low 20s, but offers a 7.3% dividend. This is a company, of course, has great structural advantages with a great sales force worldwide, great R&D pipeline, superior management under Albert Boras. I say grab that 7.3% dividend, grab the almost 10% free cash flow yield because, a year from now, we're still going to need a lot of drugs. And guess what? A year from now, RFK Jr. at the rate he's going may not be in place.
All right. Also watching very closely what's happening with the global economy. Folks are bracing for maybe a slowdown. Some say a recession. And then, of course, that's been having an impact on oil prices. On the year, we are seeing the past 12 months, WTI and Brent down over 20%. But you've got your eye on Exxon. What's the story behind it?
Yeah, I think there's two things. One is, of course, with commodities, you want to buy low, sell high. And, of course, it's been 20% in U.S. dollars. But, again, to the extent that you price it in non-U.S. currencies, it's been even greater. But I do think we're seeing a worldwide reflation. We've got no longer respecting of budgets in Europe as they ramp up their defense. We just saw interest rate cut over in Europe. We think that China, of course, has to reflate its economy. And ultimately, we think the Federal Reserve will be cutting interest rates here. And so as a result, we think, the global economy is going to rebound. And now you're catching commodity prices at a very low level. But I could be wrong, of course. And that's why I like Exxon, because they're the granddaddy of all these energy companies with the best balance sheet, the best vertical diversification as an integrated, but plus geographic in diversification. You got a great dividend yield. So if industry conditions stay tough, the largest company continues to pick up market share by Exxon now.
Now, of course, they've got a friend in the White House with Donald Trump.
Absolutely. And a Republican-controlled Congress. They've traditionally been very supportive of fossil fuels, and that's got to help the fossil fuel industry, of which Exxon is the granddaddy.
All right. Great insights from David Dietze. He is the Chief Investment Strategist for Dietze Wealth Management Group. David, always great chatting with you. Thanks for your time.
My pleasure. Have a great day.
All right. Catch up with you again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.